Good afternoon, everybody. My name is Vishal Ranjan. I head all the new businesses at Virinchi. I am joined today with Mr. MVS Rao, our Group President, Mr. Shanti Priya, who is our Group CFO, and Mr. Ravindranath Kohli, who is our Company Secretary. I apologize at the onset on behalf of Mr. Satyajit Prasad, who happens to be traveling right now on the East Coast and could not make up to this call. While we have to focus specifically on the Q4 as a business, but to set a context to this, our first interaction, I'll just take a minute to explain our philosophy and business ethos before we go on the updates on Q4. Virinchi, for us, is essentially a technology company, and is something which we have been doing for the last 25 years plus. We have been public listed in 2001, and since then we have been building multiple products and technology solutions, which are primarily IT-backed, scaled across for the US as well as the Indian market. At a macro level, what we are trying to achieve are either IT products and solutions for the developed market like US, or business solutions which are essentially technology-backed, and that's how our foray into healthcare comes in the last 3 to 4 years. If you might have possibly noticed in our performances over the last 2 to 3 years, the significant diversification that we have taken in healthcare provides now 2 solid pillars or 2 solid verticals in Virinchi, one being on the FinTech side, which we'll be speaking a lot today, and on the healthcare vertical. Both of them essentially are powered by our IT know-how. So, while that's being said on the IT side, what we also possibly try to bring together is on the Q4 product in particular. So Q4 is a global market leader in offering loan management systems to microcredit lending industry in the US. We work with the top 12 of the top 20 players in that industry. And microcredit in the US, colloquially called the payday loan industry, caters primarily to close to 60 million subprime citizens of the US, of which around 25 million have taken a loan from Q4 at some point of time. I will possibly leave this number for us to chew back that at least 25 of the 60 million that we are talking about have gone through our product at some point of time. Every year, this industry sees around $12 billion of loans, which typically growing at a CAGR of 7 to 8%. While that gives, I would say, a macro picture of the industry, I'll take a minute to go deeper into what the industry is, what a payday loan does, and what essentially Q4 comes in. So, in many macro ways, I would say payday loan essentially caters to subprime guys who have pretty much exhausted their credit options, their credit cards or their hand loans or friends, family, everybody has pretty much kind of they explode. And now on, say, 20th of the month, they have a Christmas to celebrate on 25th, and they take a $500 loan from a nearby store. These are typically neighborhood stores, what you possibly see on a kind of a strip mall that you typically walk into a store, equivalent of a Western Union or what we see in India, Airtel SIM card shop, that kind of stuff. And now this industry has moved a lot into online. But the value proposition still stays the same, that it is a completely unsecured loan to a seller who might have a FICO, which is essentially civil equivalent in the US, a FICO of 400, 500, even less. So now all conventional banking products or conventional loan products are no longer available to this guy. And in that fashion, what he typically comes is with an SSN, which is equivalent of the Aadhaar card, or he may just have a driving license and he walks to a store or makes an online application and wants a $500 loan. Now, what we work with our lenders, so first of all, we do not carry the loan book ever. We work with multiple large NBFCs which are NASDAQ listed billion-dollar companies on their own. And for them, we run the ERP or the loan management system beginning to end. And in these kind of cases, what happens is, we will probably do an underwriting of this guy, which typically may not be sufficiently done through a FICO score. So what we might go ahead and possibly hit the bank account, look into the kind of cash inflow that this guy has. In the U.S., sometimes people get salary bi-weekly instead of monthly. Or we will possibly see in the last 12 months where this guy is getting a payday loan, as in, does the salary come on a paycheck day and all. Based on that, we may possibly get some understanding of this fellow. Thereafter, we may possibly look into his address or what there's an integration with something called a LexisNexis, whereupon we try to say what is the kind of zip code he's staying, how long he has been staying, how long is the lease agreement, and so on and so forth. And then we possibly make a point if this guy is on a particular blacklisted zip code, we do not want to possibly move ahead with this one. He's a high-risk customer. Then possibly we may also look into his utility payments, whether he has been paying his electricity bill on time. If it's the middle of winter and he has not bothered to pay his gas bills, pretty much he's a desperate guy to talk about. Similarly, the kind of car he is driving, there's something called black book integration. So net, what we try to do is we are close to 30-35 different data sources in the US we have integrated, and all in a flash of few seconds. In the online world, you have to give a decision yes or no pretty much in real time, I would say in a couple of seconds. Even in a storefront model where the guy is outside the counter, you have to give a yes or a no, possibly in those 2 to 3 minutes maximum. And at that point of time, what we say that, okay, this guy is not good for a $1,000 loan, maybe maximum for a $600 or $800 loan. And what is more interesting is the APR that is associated with it, the interest rate we talk about. Now, because this guy has taken a $500 loan, you charge a $20, $30 admin fee and then say that I will be swiping $525 on the first of the month. Net looks like a $30, $40 kind of a spend, but because it's only a 15-day or maximum of a 30-day loan, the APR calculates back to 300, 400%. Needless to say, the defaults are also high, something like 30-35% is the norm for the industry. So what we do a lot, because we have interacted and underwritten close to 25 million individual subprime guys, we have created a huge amount of learning, and all of this data goes into a machine learning tool by which we can come back and say pretty much in certain zip codes, almost like 90% confidence whether this guy will be able to pay back his $500 or $700 due. And that is a huge amount of intellectual property that we carry, and I'll probably push it to the extent, we had a services call discussion with one of the IT, large, financial services banking industry guy. And our pitch was that how to give a loan to a guy who is the 500 FICO or less. Perhaps other than us, nobody else on the planet has the data. So if somebody has to build a product and try to, serve to that segment, either us or nobody else can possibly tell what are the parameters to look at and how to possibly underwrite and price that risk. So that these kind of things for the last 10, 12 years have been growing in the product, and that amount of IP has helped to a huge amount of stickiness to our customers. When I say stickiness, today's discussion will focus a bit about our Advanced America contract. We did our first piece of project in 2007 with Advanced America. It's now 11 years with them, and now they have just signed for another 5 years or more. That will be a typical average relationship with most of our large customers. So in the last 5 years, so I can't remember a client that we would have lost. And it's also because the stickiness that is not just because of our knowledge and the intellectual property. The stickiness is also about because it's another system for them. Right now, from a customer walking into the store to the loan process or loan journey, not just an underwriting, the guy wants to make a repayment, wants to do a refinance, and thereafter possibly we have to do a collection. And at the last point of it, you have to write off a loan, you want to sell it, I don't know, for 25 cents per dollar or maybe 10 cents per dollar. We do those kind of integrations and sell off the loan. So for those customers, or for those, I would say NBFC, we are the SAP for them. Means you cannot change your ERP overnight. And in fact, there are instances where a couple of customers, including Advanced America at certain stage, were looking to either get an external vendor or possibly try to do it in-house. The whole complexity of this kind of business is such that either you have to be agile and a cost-effective one, or you will not be able to meet the challenges of this industry. Staying on the industry, as you might have imagined, because we are talking about 300-350% kind of APR, it attracts a huge amount of regulatory oversight. When I say regulatory oversight, right from local laws to the state laws to the federal laws, there is a CFPB, which is a Consumer Forum Protection Board. All of these guys keep making multiple rules, which each of these statewide vendors have to negotiate and comply with. In that kind of a scenario, what happens, suddenly there might be a lobbyist or a senator who make a long statement saying that, this is a predatory lending and it is not good for the customer and so on and so forth. And, you cannot give more than 2 loans to the same guy in 6 months. Now, the moment this kind of changes happen, all our customers are impacted. We get a service income, we get a customization service income, and we make those changes. Thereupon, nobody gets more than 2 loans in a 6-month period. And almost every single loan has to be reported to close like 18 to 20 agencies on a daily basis, weekly basis, quarterly review, all of that. Now, what happens is, this is the same senators, now there's a Republican government and now the sentiment is more from business-friendly side of it. So now there'll be a second senator who might lobby saying that if we stop this industry, if we, block the growth of this industry, all of these subprime guys, which are very much their strong target, would go underground. They would go to the mafia, they would go to the local loan sharks and all, and there's no way to protect this industry. And at least we have visibility, we have been able to do the customer control and all litigation of those things. So that kind of a semantic for the last 10 years that we have been sitting in this industry have been going on quarter on quarter. And we intend to see that happening continuously. And hence, for us, it is also imperative that we are at the top of what is going to happen in the industry. In fact, in many places, Satyajit, our CEO who sits in the US, is almost an industry leader. He's an industry thought leader who speaks on those forums earlier last week. And he was explaining what the kind of data that we have collected, what the kind of customer behavior we are seeing, and what kind of industry initiative we have to talk about. Now, when we are in that kind of a leadership position, as we possibly see now, close to 20-25% of all such loans would go through Q4. So you are pretty much controlling the industry. The next, I would say, the competition which we talk about is hardly 40% of our size compared to our 400 people team. There'll be like a 30-35 people team based out of West Coast. Now, sitting in the U.S. with a U.S. cost to deliver, it's hardly a competition for them to, there's a chance for them to compete for our customers. Because there's so much of flux that exists, there's so much of domain that is required, and there's so much of fluidity that is there. You need to have the ability to deliver those customer changes. You should have the ability to be agile and anticipate industry and to deliver it at India cost. That is something which you won't expect from a U.S. competing guy. The other usual suspects that you typically see in the U.S., people like the CTS and the Infosys of the world, they, for multiple reasons ranging from that, this is kind of a niche industry, so they don't really want to build that practice for now. And for them, this domain is so deep that unless you invest that 7, 8, 10 years, you will not be able to do the matching product requirement. One of our, very old clients actually flirted with Infosys at some point of time where, they gave them an analytics business dashboard kind of a work. And unlike a services industry where you need a written SRS and a written requirement document, in that 6 months, 9 months, the requirements changed so many times that the project was abandoned and we eventually executed the project. So that is the kind of industry we are talking about. This is a kind of a very unique place where, close to as of now we are talking about $12 billion of loan going to our product. We are talking about a very consolidated cash cow position whereupon no serious competition exists, and we are already now, going deeper and deeper into our customer relationships. And this is something which is, because it's mission critical and because we are already working with a large guy, even the smaller guys are gravitating towards us. Because, now this industry, with so much of reporting and so much of Excel sheets that they were carrying earlier, now with 5-store or 10-store players cannot really, survive as profitably. The moment you grow from 10 to 15 or maybe a 100-store player, it becomes so complex that you cannot run the show, and hence you sell it off to the bigger guys. So one of our large customers, NCP Finance, has possibly grown through acquisition, and when we started with them, possibly they were at a kind of a single store kind of a identity. Now it has pretty much grown to like second or third largest of our portfolio. So this is an industry which is consolidating, and if you're working with the 12 or the top big guys, and the online business which is going through, let's call it the hybrid business where you can take a loan online, you can take offline and all of that. We are pretty much at the top of that industry curve and the technology curve. And we intend, or at least look to sustain that relationship. And in fact, that also explains Advance America's signing this agreement. And I'll possibly give a bit of more context to that. We were working on around 1,200 stores for Advance America for a specific product on payday loan. Now, there are some adjacent products, like something they call it a title loan, which is essentially a second lien on your car. So what I may say that if it's a $10,000 car or a $5,000 car as a black book, and you already have paid some equity, say $2,000 you have paid the EMI, and there's $3,000 that's still outstanding. So that $2,000 becomes available credit for us. So you may be able to give a $600, $700, $800 loan to that. So now this is still a variant of the same short-term micro loan industry, but there is certain collateral sitting. Needless to say, it becomes more complicated because you have to instantaneously find out about that registration number, find out if there is history to that accident, or you find out what's the market value, whether there is a resale, and so on and so forth. So now what I'm trying to get into is that Advance America, they were innovating on their products, they were adding more geography, and for them, the route of doing it in-house was very fast getting shut. So they had kept that option open through small little products for those variant growth, and then they figured out that as they expand geographies or products or new states, they cannot survive with their own ad hoc, pseudo Excel or pseudo web-based products that they have created. So I would say we have been negotiating with them for close to 7-8 months now, and we have been serving them for long. And as you might imagine, these are long service cycles, long sales cycle. But with that, what Satyajit and the US team have achieved now is a 5-year contract, which, as Satyajit spoke in one of his interactions, translates to around 270-280 crores kind of fixed revenue. And a lot of it is front-loaded at this stage. And And this particular contract which we are seeing has a 5-year tenure with an auto-renewal clause on it. And speaking specifically for the next 12 months, those who possibly have our last numbers handy, you might recall our product revenue. Last year we reported around 92 crores. And for the last 3 quarters, we have already crossed the 94-95 crore number. If you just annualize it, that comes to around 125-126 crores. We expect this particular contract in this 12-month period. A lot of it is front-loaded, but the rollout possibly are quite, I'd say 5 to 6 quarters is when the rollout will go in. So this 125-126 annualized revenue should see at least 18 to 20 crores additional revenue added in the next 12 months. And, subsequent years, because we are talking about this annualizing to 5 years, this incremental 20 crores revenue is definitely available for us in the 5 years with auto renewal at the top. One important part here when we talk about revenue it's actually true for all our customers anyway. These are all SaaS-based revenues. So when I say SaaS-based, it's typically linked to the number of loan transactions they are doing, either number of loans or number of collections. Sometimes we extrapolate it to the number of stores. So what may happen is if it's a small, young organization which is adding new stores, they may not have a lot of loan volume. So we take a kind of extrapolated number and say that, okay, we'll calculate the number of stores, assuming so many loans will grow over a period of time. But for our understanding purpose or how we see these calculations, they are typically linked to the volume of the business, so which was growing at 7-8% historically for the industry while the larger players are growing faster because there's a consolidation and new geographies going in. That is number one. While we have, the SaaS business income is always good because we do a license cost and we'll talk about the, EBITDA cost margin is much minimum. The second part which becomes more interesting is on the kind of service revenue that we get either through customization or implementation. So the moment you move from maybe 1,200 stores to 2,000 stores, you need to be in that geography. You need to, do a training. You need to do configuration. You need to do data migration. So we earn a significant amount of implementation income. And as the industry grows or as these kind of changes come in, there will be continuous service income in terms of customization that we grow in. While all those numbers are available and possibly as cherry on the cake, we can keep talking about it. But for our current understanding, the contracts that we have signed, we are seeing those 18 to 20 crores of additional revenue pretty much visible in the next 4 quarters. What is also interesting is because these are numbers which are linked to our SaaS-based income, the incremental cost to deliver these kind of revenues are hardly any. Think of it like it's a Facebook where if another 1 million customers come in, there's a marginal hardware cost, but that's the end of it. So for us, this is hugely EBITDA accretive. And when I say EBITDA accretive, possibly in the first year when we are talking about the next quarter, at max we might be seeing maybe $500,000 kind of a hardware purchase. Say give or take, 2.5, 3 crore kind of part of it. But put together, we are seeing this to be accretive toward the EBITDA side, which should further improve in the next few years. And this should add, give or take, around 13 to 15 crores kind of EBITDA for this business as we move forward. Mostly because this EBITDA does not have sitting with a lot of depreciation or interest, except for the 30% tax, which will possibly go down on the way into the tax. So net-net, the Advanced America should add, both in terms of revenue, EBITDA, as well as on the tax, a significant growth for the Virinchi Virinchi overall numbers as we go through. What is also relevant from our perspective that this is not the end of the business for Advanced America. There are adjacent revenue sources, not in terms of customization, but also in terms of products. Especially if we talk about one of the adjacent products that we are talking about, equivalent of what we call it AEZ. Which is what we are looking into is not just into the B2B sitting into with our existing customers, but possibly look into those customers in terms of NBFC talk is the B2C side of it, where we are sitting possibly next to the merchants places, equivalent of what you see as a Bajaj Finserv or equivalent of it. And what we are able to do here is in the PayEasy part of it, what we are able to look for the same target customers, which are typically underserved for retail credit, and working with the same lenders on the backside, we try to tie up with merchants and allow these loans to be originated at the merchant side. So that being one of the adjacent products further increases our revenue. And, similar products that we are looking to roll out for India, which we spoke briefly about earlier in our interactions around V-Card, are all built on the platform of that machine learning tools of managing 25 million individual loan books, managing multiple sources of underwriting, origination, customer service, collection, and all of it. And that knowledge of the financial technology product allows us to build IT-backed business solutions for markets outside US, including in India. With that as a framework, I'll possibly take a pause here and keep the room open for questions around Q1.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Lavesh from Sushil Finance. Please go ahead.
Good afternoon, sir.
Good afternoon.
Yeah, my name is Lavesh and I'm from Sushil Finance. I just wanted to know that the Virinchi is expanding into its hospital business too.
Could you just repeat your question, please?
Yeah, Virinchi is expanding into hospital business too. So,
yes.
Is there any plan to demerge the hospital business or something for shareholders?
To be honest, while those options are definitely available to us and we do get multiple inputs to it, but at least looking into the next 4 quarters, we do not explore that option seriously. And the intent here is for 2 reasons. While healthcare business, or at least a big part of healthcare business looks visible as a standalone business, we see huge amount of synergies in the way we are conducting our healthcare business. So I definitely encourage each one of you on the call to find an opportunity to visit us in Hyderabad. But when I was talking about the brick and click business of it, I think the patient experience that we are providing is not limited to just doing surgeries and the outpatients, but also a lot around, the technology experience right from the moment you walk into the doctor's room, taking an appointment, the moment you walk out, possibly you're seeing, your prescription on your mobile app, the medicines are already available as you walk in. And then further, I would say democratize the technology, not just in our own hospitals, but also into adjacent partner hospitals, not only in Hyderabad, but nearby through our mobility product called V23. So as of now, the technology part of healthcare is intrinsic to our identity. We do not see a strategic reason to keep them apart. But yes, from the investor community, there is a question that very often there's a discussion comes in that if we demerge it, both of these businesses will have their own valuation come. At this point of time, the synergies are allowing us to grow fairly well.
Okay, thank you, sir. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Rakesh Jain from Asit C. Mehta. Please go ahead.
Hello, sir. Sir, I had a few questions. The first one, so you said that you have about almost top 12 companies as a part of your clientele in the payday loans. So what percentage of their, spending on payday loans like you fund, what is the wallet share of Virinchi in that? Like how is there any other player besides us? What percentage are we getting from this top 12 clients?
Great question, and I'll put it this way. We are pretty much the only IT guy for those people. So even if it's an infrastructure for cloud setup, we do it. Even if there's an analytics BI tool, barring here and there small pieces as I talked about earlier, they wanted to do a pilot here and there, we are possibly capturing that 99%, if I would say 90% of their IT spend. In fact, at times we also procure their hardware, not only the client centers part of it. So the question will come from the IT wallet. We control pretty much everything. But yes, in terms of the P&L, we will...
Hello?
Sir, you're not audible. Hello, Mr. Vishal Ranjan.
Hello, am I audible, please?
Yes, sir, now you're audible.
I'm sorry. What I was trying to explain is that in terms of their IT spend, we control 95% of their wallet. However, because these are NBFCs with a large loan book, the major costs are obviously around the cost of funds.
Okay. So you were saying something about the PML thing. Could you repeat that?
No, the question where I was coming from, that in the IT spend, whatever they are looking to do, we are pretty much everywhere. But if you take any NBFC's PNL, I think comparable could be taken from an India book also. We do not form a huge cost of their PNL. And hence, in fact, just to conclude that, one of the discussions in our IT projects were also that since that line item is not too huge at the CFO level, they don't see a huge reason to either in-house it or to, keep cutting on the cost or do a, price pressure on that. Ultimately for them, if we are able to run a tight ship, it's like, an SAP for them, it's the cost of doing business.
Okay. So, what could be the reasons? There's no other player who else is doing, serving this industry, which is growing at 7 to 8% CAGR, and which has such a high demand, where there are unsecured loans, and, where they don't have the conventional banking options. So, why there has been no serious player or competition for us? What are these reasons behind it?
Okay, I think it's a fantastic context question that I'll take a moment here. So long ago when the U.S. economy was coming, these were typically neighborhood stores. So I know you personally, and hence I give you an unsecured loan. Now, since 2003, 2004, the CFPB came in and this industry starts seeing scale. So the big guys we are talking about, they have started growing fast, I would say in the last 15, 20 years. And it will continue to grow because of the, consolidation as you would expect in any industry. There are still 20,000 payday loan providers in the U.S. So when I was talking about 12 of the top 20 organized guys, there will be people with like 200, 300 stores and above. But there are still, I would say, a 19,000 change, which are possibly 2 stores, 3 stores guys. Think of exactly the, mom and pop shops that we can think in the U.S. as an economy. So now those guys are difficult to serve, difficult to find it, and they were doing their life reasonably okay on the Excel sheets of the world, or, minor variants of the Excel sheets. Now, because of the regulatory oversight, their cost of doing business is difficult. So while those small mom and pop guys will continue to survive, anybody who has grown to 50, 60 or maybe 100 stores, they find trouble in doing the reporting, meeting the regulatory regulations and so on and so forth. So they have to pick up a larger guy. Now, Q1, while it becomes a larger guy, they may typically take their own cycle time to change their business model or come to our platform because it's like an ERP change. But what is good for us is the bigger guys are going up and gobbling those 100 stores, 200 store guys per se. So for us, I don't need to do the sales at the retail level, which is expensive to acquire and service, as you'd imagine. So we are growing with the industry pretty much well in that fashion. But the large guys, why does an Infosys not see it? I would possibly say on the scale itself, if you're talking about 150, 200 crore kind of a top line for Q1, Infosys will probably take, another 5 to 7 years with all its might to get that scale. So I don't think they will spend that much of effort. They'll possibly go to a Bank of America or a Wells Fargo and get those, revenues in possibly just a change request. Now what remains are the smaller guys. Either they are America-based or the Indian smaller guys, they cannot invest for 7-8 years to learn this product. So we are pretty much in a kind of, that's the correct industry for long enough, and that is the entry barrier for a new guy.
Okay. So, coming back to that, why, geographically, you have been only doing this? I understand that the U.S. is a big market, but the geographical diversification, haven't we looked at through this? U.S. we have observed the crisis could have happened once, and it may happen even in future. There's uncertainty always. So the geographical diversification is the company looking at this point in time?
Actually, yes, and I'll put in a kind of 2 contexts. One of our customers, again, took us to UK. So we had a fair amount of installations in UK at some point of time, I would say around 4 years back. But then they were not able to scale up and something happened, so we came back from. So for us, the option to do business in UK is still available because we know that industry well. But it's also important to understand that whatever the 60 million people that I'm talking about was pretty much the subprime population in the US. So far, the US still continues to be a consumption economy. When they, borrow to today from the future, this kind of industry will continue to happen. What you said is correct. In 2008, 2009, we had a kind of a windfall year for our customers because pretty much everybody was out of job and they had to pay their health bills or rent bills, etc. But even in the height of the U.S. economy, now which is kind of recovering, we don't see a significant diminishing population or demand on the payday loan, because that is something which is catering to, as I said, means the lower income group of US, which continues to exist for a long time for now.
Right. So, sir, as a scheme of, your revenue calculation, which you mentioned that you have been using two methods. One is the number of loans and another is the number of stores. So, currently, how many loans, what is the volume are we doing in the payday segment?
So at this point of time, we are doing around a monthly 500,000 loans. Let's give and take 450 to 500,000, depending on what it, the season is. But with that 500,000 loans, now with Advance America, it will grow significantly higher. I would not take a guess on the exact numbers until we have some data coming in.
And what percentage do we typically take on this 500,000?
So, I would also clarify, because we have small ticket loans, $500, $800, maximum $1,200 kind of loan, we do not really link it to the value of the loan. So, because, if somebody has taken a $1,200 loan and you want a certain large percentage of it, it becomes a problem for the customer to calculate. So, we take typically number of loans rather than value of loan. Give or take these kind of relationships depending on what customer we are seeing. We are seeing anything between, I think the number per loan calculation is not the piece we are talking about, because this is related to the kind of number of storefronts and all. But you can possibly divide our 500,000 per month loan with the revenue we are seeing, and that is the momentum that you can calculate.
Right. Sir, since your revenue is completely concentrated outside India, and what kind of hedging policy do you follow at this point in time?
Yeah, so while our huge amount of revenues are in dollars, we have taken the suitable hedging that is, as advised by corporate finance. The thing, because of the current, exchange rates outlook, not always it is profitable to carry a hedge part of it. So we are taking a quarter-to-quarter view. But so far, I don't think we have had a major currency shock since the days of 45.50. And in fact, when it moved from 45 to 65, it was more of a pleasant surprise than a shock for us.
So, what percentage of what percentage of our revenue do we keep it as hedge? Or is there any, or we are completely exposed to the fluctuations?
Around 3% of the revenue would definitely be hedged for us. The rest of it, just to get my CFO to I'm sorry, I just got that number wrong. We are looking around 30% of our revenue to be hedged at any point of time.
Okay, 30%. And the remaining we reviewed on a quarterly basis?
Yes.
Okay. So how many out of this top 12 companies which we have, what percentage of market share do they control?
As I said, on the organized player base, these guys would be around 25% for sure. And in fact, I would say organized would typically say the top 50 guys, if you those who file tax returns and those kind of stuff. We're talking about at least 25% of all payday loans go through our product.
Okay. And with this new order coming in, which you mentioned that we'll have every quarter about, I missed out that number, how much new incremental revenue would be added with this new order?
Okay, so while there's a front loading to it, cash flows are part, but in the 5-6 quarters hereafter, what we are expecting, at least for this financial year looking in, is anything between 18 to 20 crores additional revenue coming in for the product business.
Okay. And are you expecting any more deal closures in near term similar to this?
There is a pipeline, but as you would have imagined, these are typically long sales cycles. So I don't think it might be, for example, one of the large deals that we did also, obviously this is bigger, but a comparable deal was with QC Holding, which we did last February. So 2017 February. So that was something which we always came back to the market. So you can expect that kind of number. But the good part also important here, because we have 5-year contracts and the revenues are spread over it, these are not necessarily lumpy revenues. The contract that comes may look like a large contract once in a while, but now that it is there, this 18-20 crores increasing with the customization and all is there visible for me for the next 5 years. Okay. So similarly, the EBITDA, right now I may do some capex here and there, but once that is done, pretty much all of this revenue is available to me as a EBITDA accretive number. So what I'm looking here is what exactly, whether it is obviously right now, if you talk about Q1, we are as a product business doing a 33% EBITDA. This one will push our EBITDA a few percentages, but in general, as a product company, we are doing very healthy EBITDA going forward for the next 5 years.
And any new product which you are planning to launch in a similar fashion?
Yeah, so as I mentioned, there are adjacent products which are not necessarily B2B. So in the US also, we are looking to do a B2C product, which is equivalent of what you would say Bajaj Finserv in the US. But that is again targeted to be high-risk subprime guys. And unlike selling, say TV or a fridge, which are still a discretionary purchase, we are focusing on those distressed purchases. Now, if you suddenly go to a dentist and he give you a $5,000 cost for a RCT, and this fellow doesn't have, he just walks away in a pain. So there, what we are saying that I'll give you that $5,000 or $3,000 kind of financing which is needed at that point, and which I can charge the kind of interest rates that are relevant there, and for whatever is commensurate to the risk. At the same time, we are also able to reach similar kind of segment across from the same lender and the customer combination that we are good at.
Right. So you are right now doing about 30% of margins.
Yeah.
So this could further improve on as in when we get the incremental business from the deals which we are closing now. That's what you meant, right?
Yeah, at least on this one which we are talking about, whatever the numbers we are seeing on the new revenue, they will not have a huge cost associated with it.
Right. And talking about the hospital business, what utilizations are they operating at right now?
We'll obviously be speaking in much more detail on the hospitals once I have the audited numbers for the last quarter, but to give a range of the numbers, we are right now already at 20% occupancy, and in the last 3 cumulative quarters, we have already reported aggregated EBITDA of around 14-15 crores. So net, I think on the healthcare business, we are standing well on our feet and improving day by day.
So you mentioned that in the healthcare you are planning to do some digital servicing wherein you'll have everything online, you collect data and you provide this analytical solutions. So, and there are already few startups which are there. I mean, you would be also knowing about them, and
sure.
They are also doing a similar sort of business. So how are we changing? Are we changing the face of the way this business is done in a profitable manner, or are we competing with them in a similar fashion?
Okay, I think it's an excellent question. It also defines how we want to play in healthcare. And just to give a context, when we acquired our healthcare IT business in 2013, the intent was to build a brick-and-click model to healthcare. Now, I'll take a moment to define what we are trying to do here. While an Apollos of the world continues to add capacities and do a physical hospital, but if I were to touch 1 billion people, and that's actually such a vision level, that's what we are looking to build business models, where I have a way to reach 1 billion patients across the country. Now, what happens in that kind of model, we cannot keep building hospitals and, serve. Even the government can touch only so many hospitals. So now when the government comes up with a program of, Ayushman program, they're still chasing close to, 500 million kind of a population. So that is the scale they are talking about. Now, the moment you put a click to the brick, then this kind of scalability becomes available to you. Now, can just a click model, can just a Wipro do that, or just a TCS do that, or can just a Practo do that, can just a Call Health do that, or whatever the IT businesses we are doing. Our experience suggests unless you build a business solution and not leave as a directory service, these kind of healthcare, which are kind of touch and feel businesses, don't scale up too much. And again, each of the competition has their own business model, and I'm very sure they are doing very well for themselves. Our take of the story is, say if I give an example here of a different industry, like before Uber came, and when you wanted a kind of a driver to take you to, or a taxi to take you to the airport, the only option you had was to go to Just Dial. And you see in the directory, find a driver and let somebody to reach you, a maximum kind of solution. But what you have got today is a click on button, your problem of moving from one point to the other gets solved. Our take here is that if I'm able to do healthcare in a brick-and-click manner, which unlike a Practo or the other, soft-only solutions which are there, I can deliver healthcare to you. I can become an Uber where I solve your problem. So let's stay on this problem for a moment when I say that not only that the technology will allow you to find a doctor, make a payment, go to that clinic which the clinic already knows about your medical record, all your past history, lab reports. He makes a prescription which again can be done in our product. That prescription can fly electronically to the nearby lab and pharmacy, and the lab guy can send somebody to collect your samples. The pharmacy guy can possibly send medicines to you, and the problem of outpatient care gets solved. And the proof of the pudding is right now the work which we are doing with Uttar Pradesh government. When we say 1 billion patients or 100 crore, patients, a state like Uttar Pradesh last year for their 4,000 physical hospitals saw 12 crore patients in a year. If we are solving this problem even for their top 800 district hospitals, not the PHCs, district hospitals and CHCs, which is what we are right now rolling it out. We have the contract to roll it out for all the 4,000 hospitals. But even if I do for 800 hospitals, I have a visibility to touch close to 6 crore patients in Uttar Pradesh alone. Now, with that kind of a model, not only that I can manage the health records, I can do a cross-selling of all our healthcare services, and incidentally, I may end up having a hospital in Uttar Pradesh. Very good. Even if I don't have, the government hospitals or the partner hospitals can solve your Uber problem. So you can find an ultrasound nearby, you can know the payment for the ultrasound, you can pay for ultrasound, and you can get the ultrasound done and the report stays with you forever. So that is the model we are chasing in healthcare.
Right. Yeah, I think so. I'm pretty much done with my questions, sir. Thank you so much for answering it patiently. All the best.
Thank you.
Thank you. The next question is from the line of Rudhi Burma from KSA Securities. Please go ahead.
Yeah, hi, good evening. I want to understand something. Now, when you spoke about the demerger concept earlier where people are recommending that you go for the demerger, what I understand is your IT business is throwing up free cash flows. So wouldn't the plan be more like to fund your healthcare expansion by using the cash flows from the IT business?
To be honest, there are two. There's a smart answer, there's a correct answer. So let me give you a correct answer. So the answer here is right now my healthcare business is already, growing fairly well. And because of my fixed cost structure, we have already taken the, funds that I needed from the IT business to do the CapEx, etc. So I don't see my IT business to be subsidizing my healthcare business going forward. If anything, the kind of momentum we have seen by this financial year, the healthcare business should be standing on its feet very well. But does it mean that we will use the same free cash flow from the hospitals or for the IT to add new facility or new capacity? I actually do not have a very good answer there because right now, for example, we executed this project for like 40 lakhs a bed, which is pretty much low for the industry standard. Say if I go out of Hyderabad and we want to expand, we may end up doing like 50, maybe 60 lakhs a bed. We'll definitely never do a crore a bed kind of a business. So if I'm doing that, obviously it will be a mix of equity plus free cash flow plus debt coming in. I don't think I will have that amount of free cash flow in the next 12, 24 months to finance the hospital completely from my hospital business. So whether I get external equity, whether I raise it from the primary market, whether my IT business, like with this Advanced America coming in, I have some equity. We have all the options available, but whatever will be the best value creation option there, because debt is cheapest for me. Means obviously all of us would like to have as much correct amount of leverage that we can get so that the debt is cheapest. But the options of equity or options of free cash flow are still available. But at this point of time, at least for the next 12 months, we are chasing to make the hospital standing well on its feet, generate a lot more EBITDA, generate a lot more cash, start paying its, already it is paying the principal part of EMI very well. I think by end of this financial year, we should definitely be paying off my, what you call it, the book break-even. All of those things will possibly come. And right now, my focus is to run the hospital business better.
Got it. Okay, and regarding the balance 250 beds that are to be made operational, what is the timeline on that?
Okay, at this point of time, there's a 50, how we have seen this expansion, as we know personally, the 350 bed in the Banjara Hills and 200 beds of the other two facilities are been running commission, doing fairly well. Now, we are commissioning another 50 beds in this, couple of months. Definitely this quarter we can take it. We have a visibility of, rolling out additional 100 beds for sure on a 60-day notice. But we are just, chasing our occupancy. At this point of time, because my occupancy does not require me to do that expansion. My funds are lined up. I know exactly what I need to do. It's just that, that 60-day will start when I see my occupancy, creating operating issues.
Okay, fine. But what is the occupancy level right now at the Banjara Hills Hospital?
Give or take 70-75 beds.
No, what is the, okay, fine. And what about the older hospitals that are there?
They are running, I think, stable at around 50. One of them is at 50, others at 70% reasonably stable. So there is a room for going up, but I don't think it will dramatically increase in this, next 6 to 12 months. The major capacity beds will come from Banjara.
Fine, got it. And going forward, what is the sort of revenue split that you see between your IT and your hospital business? What is the target that you have in mind?
Okay, as of now, we know, at least for the last financial year reported, healthcare was only 53 crores out of 280. That still will move, even if I analyze the number where we are seeing that is already improving on the favor of healthcare. In the end state, the way we are investing both in our technology as well as healthcare, we would possibly like to have a 50-50 ratio. But that is something which will always be a back and forth based on our expansions in each of these two verticals.
Okay, fine, got it. But, the reason I asked, coming back to the first question, is that when you stated a target of getting to 5,000 beds in 5 years, if you, to do that, to achieve that, probably you'll need to take on a significant amount of debt.
Correct.
But that's what I was saying, whether you will subsidize it using your IT business, or will you at some point look at the demerger and say, the hospital business has to fend for itself?
As I said, at this stage, while the options are available on the table, while demerger allows me that additional fund source, my current IT business at least ensures that we never have a distress call. Options for external equity investors are actually not only available, they are something which we, have some, here and there inquiries coming in always once in a while. All of this will depend on the correct timing. If I want to do it tomorrow, am I ready? Maybe not. What happens in the next 6 to 12 months will also decide the pace in which I can expand to that 5,000 beds. And that 5,000 beds may not necessarily be greenfield, could be brownfield, could be acquisition. So all those strategic options would be available depending on how we perform over this next 12 months. But even where we are right now with the EBITDA that we are showing, with the kind of self-sustaining model that we have already achieved in hospitals, I don't think we are looking to do any distressed debt raising or distressed, capital raising on either side, either equity or debt.
Okay, got it. Thanks, that's all from my side. Thank you so much.
Thank you. The next question is from the line of Varun Kia from Equity Capital. Please go ahead.
Hello.
Good evening.
Hello. Yeah, good evening, sir. Firstly, I wanted to just confirm that you mentioned this Advanced America Q fund revenue would be around 270 to 280 crores. So that is additional, or will it be total of 2,000 stores?
I think there is a background noise. Could you possibly repeat the question for me, sir?
Yeah, the 270 to 280 crore additional revenue, the revenue from Advanced America from 2,000 stores, is it additional or is it total for 2,000 stores?
No, this contract that has been signed is value 260 crore, 275, depending on the dollar, to 75-80 crores over the next 5 years. So this is not the incremental number. The incremental number which I've just spoken to you, at least for this financial year, looks in the range of 18 to 20 crores.
Okay. And what EBITDA margins would be earned on that? Around 18 to 20%, right?
As I said, this new revenue, this incremental 18-20 crore revenue we are talking about, other than some one-time cost, pretty much it is EBITDA accretive. You can easily take a range of 13 to 15 crores kind of EBITDA coming out of it.
Okay. And lastly, I wanted to ask how much cash is being burned on the healthcare front currently?
Sorry, this is the cash involved, sorry?
The cash being burned, the total cost on interest and stuff on the healthcare front.
Can you please repeat the question?
How much cash is being burned on the healthcare front currently? We have not reached the break-even level, right?
Let us answer it like this. In the case of healthcare, right now we have a EBITDA of about 14 crores for the first 3 quarters.
Right.
Okay, and the things which should be left over in there are the interest and the principal repayments.
Right.
The interest is roughly about, 8 crore.
Okay.
8 crore for the year, so that is covered. And the principal amount right now is on a, back-ended kind of a thing. It's a ballooning repayment structure.
Okay.
So we're paying about, 3.5 to 4 crores this year. So the cash flows just about are sufficient enough to take care.
Okay. Okay. Got it. Thank you.
Yeah. So right now we're doing fine.
Okay.
Thank you. The next question is from the line of Kalpesh Ji from Veda Investments. Please go ahead.
Hello.
Good evening, Kalpesh.
Yeah, hi Vishal. Thanks for the call. Vishal, you spoke about the hospital business. We are targeting the certain number of beds by next 5 years. Coming to the, current 600 bed plan, by what time we can, start operational the 600 bed?
So as I said, as of now, the 350 plus 200, 550 is commissioned. Another 50 is something which, because now capacity is quite, certain kind of arrogatory beds which we need, that is creating already a capacity hit once in a while. So we are adding our 50 beds this quarter for sure. And I have an ability to add my next 100 beds, pretty much in a 60-day time. So it will depend on my occupancy as we see. The moment I start seeing my patients suffering or my quality of service coming down because of unavailability of the bed, I will just start from minus 60 days and get that 100 beds added. So all the funds for those 100 beds and the 50 beds are already available. The wiring and the cabling, everything is there. What I'm not doing is the commissioning of the 100 beds just because I am waiting for my occupancy to catch up.
Right. And listen, after, this 100 bed is not oncology, when we expect it to start the oncology bed then?
So now that's also a fair question. The oncology is coming now in the same name company. So oncology has typically 3 businesses. You do surgical oncology, you do medical oncology, and radiation oncology. We are already doing a fair good amount of momentum, and with a set of doctors that we have got, the surgical and medical is growing fairly fast, and they have been asking to get the radiation started right away. So within the same flagship facility that we have identified the place, the permissions are already underway, and with that going in, we will possibly be starting the radiation oncology in this block itself, while the adjacent land that we have been available, which can house another 100 beds, that will again come with the expansion needed. The moment I see my radiation oncology getting capacity utilized, I will start doing, again, that is an 8 to 9 months kind of a project cost for there. So the moment I see that, okay, now I'm getting 70% or 60% utilized on my radiation oncology, I will start the construction there. So while the funds for these projects is not a problem, the CapEx project team, the permissions, everything is lined up. When to do it is just a matter of what kind of occupancy that we see. As of now, we have not refused even one patient for the want of bed or anything.
Okay. Vishal, then, what kind of CapEx do we require for the additional expansion for the oncology?
You're talking about what side of capacity or funds?
Yeah, for the CapEx, how much amount we want?
The CapEx, typically a linear accelerator and a PET-CT would come for 20 crores. With the building and all, we can either 10. So we are talking about anything between 30 to 35 crores maximum to set up the oncology block. But as I said, that 35 crores would typically come, okay, don't hold me on that number, but until I'm doing 35% occupancy, I will not be doing that spend. And if I'm doing 35% occupancy, I will have enough internal cash to fund most of the equity component of that 35 crores. So I don't think that is something which we are too much worried about at this stage.
Okay. You spoke about the, people asked you about the demerger. Is it possible, we in fact, go for the diluting the subsidiary stakes of the hospital business? Virinchi Hospital.
As I said, as you'd imagine, these are discussions that, as I said earlier, also we do get once in a while on our table. At this point of time, being an IT company and the way we are seeing the synergies in both businesses, they are pretty much entwined. Now the question of when to do a demerger to unlock value or to possibly raise capital, I think those options will start presenting ourselves possibly, I would say, 3 to 4 quarters from now. Possibly the third quarter will be a good time for us to revisit this question. And then we see how we are doing with our hospital business, how the technology part is rolling out, whether the kind of numbers that MVS just spoke about, we are pretty much now comfortable and cushioned. And the intent is definitely not to cross-subsidize healthcare perpetually. That is not the model for sure. Healthcare is already standing fairly well on the feet. Now the expansion and all may require demerger, may require a private equity, may require, again, all those fund sources are available to us. We'll speak on this possibly in more detail once we have that 2 to 3 quarter of performance behind us.
Okay, fair enough, Vishal. So, coming to the Q fund, you spoke about we have a 25% of the market share of the organized.
Yeah.
But if we look at, the industry is growing by almost 7%. So what kind of growth we can see in the future?
So, okay, if the Advanced America project was not there, we would still have grown at least that 8 to 10% that we have seen hereafter. And the EBITDA would have continued to be at the same 30 to 35% range that we have delivered quarter on quarter. And what is more important, and possibly one takeaway that I would like all of us to go home with is, this cash flow, this revenue, this EBITDA is not only well protected for this quarter or this year, it's pretty much like 5-7 years kind of a visibility. Now, add the Advanced America incremental revenue, incremental EBITDA, it becomes easier and much better. But even if you take it away with that industry and the large guys growing faster, that 8 to 10% growth that we have shown earlier should be very, very well protected as we go forward.
Okay. Fair enough. Thanks, Vishal.
Thank you very much. That was the last question. I now hand the conference over to Mr. Vishal Ranjan for closing comments.
Thanks a lot for everybody finding the time to be on the call. And I would possibly, conclude on only 2 specific lines from my side. This journey, I would say for the last 3 or 4 years, for those who have been with us in that time, those who have shown a lot of patience, those who have shown those questions about it, why we are doing healthcare, how we are looking to grow Q4. And I think this quarter or possibly this financial year marks that inflection point where those promises or those discussions that we have invested upon have started fructifying. I will possibly conclude on that note rather than talking about numbers. Whatever we invested on the product side of Q funds, whatever we have invested into the technology side of healthcare, with now possibly in a quarter or 2 once we are seeing the new investments bringing more revenues. I think this is the time where overall the business looks as good as any. Just today, I'm sure those who have tracked the market, we saw the volumes reaching all-time high. We saw the market talking about it. So I think this is a very good time for us to be a Virinchi family. Within the employee pieces we are seeing, a fair amount of enthusiasm is already coming in the healthcare and the doctors and the patients. I think we are doing all that we can to keep doing well for the next few quarters as we see. Thanks a lot for your time, and we hope to connect again once we have our audited numbers for the last quarter. And in that stage, we'll possibly have more numbers to evaluate as we go. Have a fantastic day ahead. Good day.
Thank you. Ladies and gentlemen, on behalf